So let's do our introductions real quick, then we'll get right to the interview. First of all, hi, I'm Andrew. I'm with Investors Hub, and today we're going to be chatting with ADVFN CEO Clem Chambers about his Bitcoin trading strategy. And he's also going to be talking about not just virtual gold, but physical gold too. So he's going to be talking about how he's dealing with the gold market and his vision for that market's future. Up next is Chapter Points, then we'll hear from Clem. So Bitcoin's come down and gold is languishing around a little bit. What happens next?
I think, and a lot of people are going to hate on me for this, I think we've seen the run for Bitcoin. Now, it might go back up to 42,000. And I wrote a piece for Forbes a couple of weeks ago saying that, I was out at 32 and I thought it would go to 40, but I just, couldn't bear to be hanging on the cliff edge with all my gains. So I sold. And it said, well, probably go to 42. There's a nice little chart showing you where it's going to go. Now, I've been drawing charts for months on Forbes. And if you look at them, you go, wow, that's amazing. You called it exactly right. How did you do that? Well, it's really simple. It's an exact repeat of 2017. It didn't take a genius to take 2017 and blow it up by 2, effectively, because it's the same principle at work. This rally is caused by the halvening that happened earlier on this year. And therefore, the price has doubled. And the peak last time was 20,000, and the halvening halved the supply. So the peak this time was double, give or take. And that's what we've seen. Well, if that is the peak or thereabouts, there's a room for a little bit of a recovery, of a last minute spike to maybe 50,000. But it will be over in hours probably, if it happens at all. It's now going to come down, and it's now going to come down a long way. Now, it's no longer an investment, not for quite a long time anyway. It's now just a trade. If you want to trade insane liquidity, absolutely do that. That's exactly what you're going to get. And there's a lot of money to be made if you get that right, because liquidity is key in those events, and volatility is a function of the market not knowing what's going to happen, and that gives a trader the ability to predict that and be right about what happens next and make a lot of money. But it's not an investment unless you want to be short, and that's not an investment either. It's not an investment because it's now going to come down over the medium term. Over the next year or 18 months, it's going to fall a long way. Now, I wrote an article yesterday, and I said, well, it's going to, could come down as low as 10,000. Then I realized I wrote an article back in October that said it's going to go to 40,000, and then it could come back to 5. Now, I don't think it will come back to 5. It could, at the very, 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 very bottom, come back to 5. But, again, it's one of those things, I predicted it was going to go back down to 5,000 before this last run. And it did, but it did it it fell from 8,000 to 5 in 2 hours and was back, to 7,000 by the time I woke up that next morning. So I missed that low. And you'll miss these lows. So I think it's quite likely that we'll see Bitcoin ranging between 10 and 20,000 after the coming fall has finished. Now, a lot of people think that it's going to go on forever, it's going to go to 200,000, blah, 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 blah. And, I'm not going to say that's impossible. I just think it's highly unlikely. There's now a lot of value in Bitcoin. Now, there's only $7 trillion of cash in the US. That's how much M1 there is in the US, $7 trillion. And it was only $4 trillion before this latest incredible ramp up that we've seen in the last few months. So $4 trillion is how much money there is in America. Not overall assets, etc., and M2 and M3 and M4 and all that stuff, but cash, dollar bills, money. There's only, up until a few weeks ago, $4 trillion of that. So 600 billion, so an eighth of that in Bitcoin, is actually an enormous amount of Bitcoin in terms of cash value. So people that think it's going to go up to $250,000 from here are basically saying that it's going to be as much Bitcoin as there are dollar bills. Well, I don't think that's likely this time around. So I believe there's a high probability that we have seen the top, and an even higher probability that the top is the top in terms of, roughly speaking, the range, 40 to 50,000. It is very unlikely to go much above that. And I think it's highly likely that it's going to thrash around here between where we are now, 30 and 40, for a few weeks, but ultimately it's heading on down to under 20,000. Under 20,000, I'll be buying. Now, I won't be diving in head first. I will be dollar cost averaging under 20,000, because that will go on in that range, I believe, I expect, until the next halvening. Well, that's 3 years from now, right? So I will be accumulating Bitcoin, if it does fall back as I'm expecting, for 3 years. So I'll be in no hurry, and I'll just be picking up a bit here and a bit there every couple of weeks, buying another chunk, as I did this time round. Now, on the other hand, away from crypto, gold is sat there sitting. And it had a little bit of a rally, and I guess that's down to your soon-to-be ex-president and the situation there. But gold is going to go a long way in the next 3 or 4 years. It's going to at least double, and it could quadruple. Now, it won't necessarily happen overnight. I don't really have a good feeling for the timing of these things. I tend to get way too early on this stuff. So maybe it's this time next year. Maybe it's the year after. But at some point, all this incredible money that's been created is going to explode gold. Now, one of the things you have to remember, everyone was saying, oh, QT, QE, they're printing money. But it didn't create inflation. The reason for that is it went to the rich. Now, when you give money to the rich, they go, oh, thank you very much. Actually, I don't need this. And they bank it. And then the banks go and lend it, and it trickles down into the economy. And actually, the rich get richer, and the poor stay employed, because all those rich people's companies and corporations, etc., and businesses and spending habits support everybody else in the pyramid of wealth. Now, the idea of handing out big fat checks to everybody is a different thing entirely, because the people who get that money will want to spend it and need to spend it. And if they didn't need to spend it, they would want to spend it anyway. So they're going to go straight out and blow it in the main. Now, that is going to create inflation. Actually, the wealth inequality that everybody moans and groans about is highly stable in terms of economic systems, because it doesn't get blown all over the place, because it goes into strong hands. And in fact, when the difference of wealth is evened out, that becomes an inflationary environment, because the money moves faster, and the velocity of money has dropped incredibly over the last few years, and that's made it very difficult to actually get growth and very difficult to get inflation. And that's because it's been going in at the top of the pyramid, and the trickle down is what everybody moans about. And what they mean is they're not seeing any of that. Well, they are, but they're not seeing it as cash in hand. They're seeing it in terms of their employment, their ability to get a new job quickly, their ability to afford a mortgage, their ability to have prosperity, because the money trickles down. Now, if you do it the opposite way and hose it in at the bottom, you're going to get maybe a boom, but you will get inflation. Maybe you'll get growth, but maybe not. It's a high risk way of going about it. And of course, politicians are doing it to buy votes, and why not? That's what they do. If anyone's going to have a hand at making a mess of it, it'll be them. So what's coming up next? All these billions being pumped in $2,000 checks to everybody, and good luck, everybody. I'm sure you'll enjoy that money. That is going to drive inflation, extremely likely to drive inflation. And that's going to blow up gold, because it's not going into strong hands, it's going into weak hands. Of course, the rich are going to get it anyway. It's just going to go from the bottom of the pyramid to the top, or from the top of the pyramid to the bottom. So it's not necessarily going to work out better for equality, but it's going to get spent. And it's going to get spent fast, and it's going to get spent not particularly wisely, and it's not going to be invested, it's going to be spent. So rather than money going in at the top and trickling down, going in the top and being invested, going in the top to keep a lot of companies that are highly geared, are really, in the old days, would be bankrupt by now. Keep them afloat. Well, it's not going from the top down, it's going from the bottom up. And maybe it won't reach them this time. Maybe Las Vegas will have a great time, and lots of engineering companies that actually need debt won't be able to get it. But actually, I don't think that's what's going to happen. There's just going to be inflation, and they're just going to keep on printing. They're going to print until a $100 bill buys what $20 buys now. Now, that might take 5 years. That might take 10 years. But that process has only just begun. Because as we've seen, there's no end to this COVID. There's absolutely no end to it. Well, not this year anyway. So that means print, and you just cannot keep printing money, and things inflationary are avoided. And especially you can't if you're going to shovel it in at the bottom of the pyramid where people are going to spend it real fast and drive prices. So gold is the place to be. Crypto, give it a year, give it 18 months. It will be buoyed by this inflation risk. But gold is going to take up the baton of this charge in safe haven assets. So I think 2021 will be the year of gold. And I'm positioned there. I'm acquiring gold stocks, big US gold stocks. Now, if you want to get sketchy, you can go to small exploratory companies or small companies. But trouble with gold, it's hard to get exposure in a safe place. You want to find a gold mine, and it's in some crazy country where, you know, there's a junta and it's almost on the edge of civil war, and that's the trouble with gold. But the majors, the gold and the Barricks and the Newmont Mining, those guys, they're big enough to be able to take the blows. They're broad enough that if one country goes up in flames, they won't lose all the production, etc. So that's where I'm going. And of course, you can buy gold, GLD, which is the ETF. And so you can get some exposure to physical gold without actually having to carry it around or dig a hole in your back garden for it. So that's also one other way to go. But for me, a little bit of a GLD and quite a bit of big cap mining stocks is the way to go, because I don't want bags of gold in my basement. I don't know about you, but it's nice to cuddle it. But I don't want to be Scrooge McDuck swimming in his swimming pool of gold coins, because I don't have a vault. So I'm, long GLD and a lot of miners, and that's probably a theme for me for the whole of the next couple of years. And I think anybody that's at all worried about inflation should be looking very hard at gold indeed.
Thanks for watching. Be sure to like, comment, and subscribe, and we try and make between 4 and 5 videos a week, so there's plenty of content for you guys to enjoy, and I'll see you again soon.